Minority Sale Book Building, Part 3. This is Lesson 3 of Class 1. In this lesson, we will review the steps and procedures while raising minority capital, and the main operational differences that practitioners should keep in mind when raising capital as opposed to a majority full sale. Background. In Part 1 of this lesson, we covered the main procedural differences between a majority and a minority deal. In Part 2 of this lesson, we covered deal procedures in the equity capital markets. Finally, in Part 3, we will discuss deal procedures in the debt capital markets. Intro to debt capital markets. Definition: a marketplace that trades capital in exchange for debt securities. Participants: the borrower. They provide interest on borrowed capital in the form of either coupon interest or a return of principal greater than the original issuance. Creditors: they provide debt capital in exchange for a future return. Main types of debt instruments: loans versus bonds. Bank loans. Debt raised from bank partners. Bank loans tend to be more conservative and require securitization and amortization. They tend to have shorter maturities with heavier covenants. Interest rates tend to be floating instruments. Corporate bonds. Debt raised from institutional or retail investors. Bonds can either be raised in public or private markets. Private companies can issue publicly traded debt. Bonds typically have a longer maturity with higher interest rates relative to bank loans. Bonds don't require securitization and are typically fixed rate instruments. Creditors versus owners. Creditors are not owners. Providers of debt capital are known as creditors. Creditors do not receive an ownership position in exchange for their capital. Rather, creditors have an outlined rate of return on their investment and prioritized position on the capital stack. Practitioners need to take this into consideration when structuring a debt deal. Given that creditors are guaranteed a rate of return and maintain a higher position on the capital stack than equity investors, for example, they have a more senior claim on the company's assets, then this means creditors also have less risk exposure relative to equity investors. Therefore, given the dynamics of risk and return, we can also assume that creditors have less return potential relative to equity investors. Furthermore, in theory, if creditors have a lower return threshold than investors, we should also assume that debt capital is cheaper than equity capital. DCM deal structure. Considerations when structuring a debt deal. The main attributes of a debt agreement are quantum, or principal, coupon pricing, payment schedules, maturity dates, and certain covenants. Although debt capital does not yield an ownership position, it still provides the creditors with some level of control and influence through covenants. Debt agreements can include three types of covenants: negative, affirmative, and financial. Negative loan covenants are restrictions applied to the borrower, for example, restrictions on additional indebtedness, declaring dividends, or engaging in a sale without permission. Affirmative loan covenants are compliance requirements for the borrower, for example, compliance with regular financial reporting, certain laws, and minimum levels of insurance. Financial loan covenants are mandates that require the borrower to maintain certain levels of financial health. For example, the borrower must achieve minimum EBITDA levels, minimum interest coverage ratios, and minimum debt to equity ratios. Thank you for tuning into this lesson, and we look forward to seeing you in our next lesson, in which we'll cover additional comments on capital raising.